Sir, very happy afternoon to all. Sir, we are going to start the next chapter called as Financing Decision in that Capital Structure. Basically, this chapter is called as Capital Structure Theories. Capital Structure Theories. Sir, we are going to take Capital Structure Decision, my dear lovable students. In this chapter, actually, three things we have to discuss. If we discuss three things, this Capital Structure Theories chapter comes to an end. Number one, various theories we are supposed to discuss. Number two, arbitrage process we are supposed to discuss. And EBIT and EPS analysis we have to discuss. These are the three areas which the ICAI will test you. Number one, theories, my dear lovable students. This is the background of the theories. We are going to have a big fight, my dear lovable students. If two firms are alike in all aspects, except capital structure, will the value of the firm change or not is the question. So what we are going to talk is there are two company man. One is A Limited and other is B Limited. Both A Limited and B Limited are doing same business. Both A Limited and B Limited business is one and the same. Capital employed are one and the same. And the risk of the business are one and the same. Sir, EBIT generated by both the business are also one and the same. That means if two firms are alike in all aspects, except capital structure. Except, will the value of the firm change or not is the question. Sir, because of the capital structure, will the value of the firm change? Sir, some theories are saying that yes, if the capital structure changes, value of the firm changes. Some theories are saying that no. How, sir, if two firms are alike in all aspects except capital structure alone, how the value of the firm change? So theories classified into two categories. There are two types of theories are there. One is theory of relevance and theory of irrelevance. Theory of relevance is saying that even though if two firms are alike in all aspects except capital structure, the value will change. There are two theories supporting the theory of relevance, that is net income approach. Number one is what? And number two is traditional approach. Number two is theory of irrelevance is net operating income approach and the Modigliani-Miller approach. Modigliani. So what is the reason why these two theories are saying if two firms are alike in all aspects? For example, A Limited is there and B Limited is there. If they are doing the same business, for example, cloth business, if they are having same capital employed, 50 lakhs and 50 lakhs, sir, since both are in the same business, the beta, the diversifiable risk, non-diversifiable risk of the company will be one and the same. And the EBIT generated by both the company are also same. Then how the value of the firm changes is what the primary understanding. Because everything should be same, the value of the firm should also be same. It's like two cows are there. Cow number one will give you 5 liters of milk and cow number two also will give you 5 liters of milk. Are you really with me? Yes, sir. If you are going and purchasing the cows in market, if someone is saying that for cow number one it is 10,000 and cow number two it is 15,000, will you accept it? No. Sir, there should be some basic reason. Sir, the basic reason is the relationship of the cost of capital. Basic reason for the difference is the relationship of the which is nothing but man KD and the K. Relationship of KD and the, my dear lovable students, KD is the cheaper source of finance. KD is the, whereas K is the costlier source of finance. K is the, sir, KD is a approximation of the profit or the charge against the profit. Charge against the profit. That means debt will be debited to the P&L account. Are you all really with me? Yes, sir. And KE is a, sir, after paying the PAT from the profit after tax, I am paying the equity dividend. Are you really with me? Which cannot be debited to the what account? P&L account. Which cannot be debited to the, that means, sir, always KE is a costlier source of finance than the KD. Always KE is a costlier source of finance than the, so the primary, sir, base of this chapter is even though two firms are alike in all aspects except capital structure. That means, sir, one firm is having debt inside the capital structure. Another firm is a all equity firm. They does not have debt in the capital structure. That means if the KD is equal to 10% and KE is equal to 15%, my dear lovable students, if a firm is a all equity firm, their 100% of the capital comprises of KE is equal to KO. That means which is equal to how much percentage? 15%. But sir, in the same place, there is another firm. In their capital structure, they are having both, sir, debt and what? Equity. If you inject debt into the what structure? Capital structure, my dear lovable students, automatically, because of the cheaper source of finance which is present inside the what structure? Capital structure. We know that KO means weighted KO, that is weighted average cost of. So KO is equal to weight of the equity into KE. Are you really with me? Plus the weight of, sir, debt into KD. That is KD into weight of the debt. This is what our KO is all about, right? So this is the basic understanding or knowledge which is saying that even though if two firms are alike in all aspects except capital structure, yes, the value of the firm will change. Yes, the value of the firm will. My dear lovable students, there are two people who are saying that yes, the value of the firm will change. That is called as net income approach and the traditional approach. So we are going to start. These are the learning objective of this chapter. Number one, capital structure theories. Number one. Number two, net income approach, shortly called as NI approach. Shortly called as. Then traditional approach. What approach? Both this theory are theory of relevance. Both this theory are theory of. Then we are having NOI approach. We are having. Then we are having Modigliani-Miller approach. Modigliani. Then we are having trade-off theory and we are having pecking order theory. What order theory? This is just a theory only. There is no numerical part from the trade-off theory and the pecking order theory. Just we have to understand for 1 or 2 mark in examination what is trade-off theory and what is pecking order theory. Are you really with me? Then we have to take a decision, capital structure decision through EBIT EPS analysis. EBIT EPS. In capital budgeting, we will use, sir, NPV as a tool to take a decision. Right, sir? Sir, the same way, sir, which capital structure I want is based upon my EBIT EPS analysis. What analysis? So first of all, so we are going to take a decision. First, the decision is the, sir, financing decision. What decision? Financing decision will lead to capital structure decision. Financing decision will lead to. So capital structure decision refer to designing the form of financing. That is which source to be tapped. So if you are going to raise a fund of 50 lakh, whether you have to raise by equity, whether you have to raise by debt, or whether you have to raise by mix of both, such a decision is called as capital structure decision. That is a chapter, capital structure decision. But it is not capital structure theories. That is different. Capital structure decision means in my capital structure, how much percentage should be the equity? How much percentage should be the debt? How much percentage should be the preference? Are you really with me? Their actual capital requirement, amount to be funded, and their relative proportion mix in the total capitalization. For example, if I am going to raise 100 lakh rupees fund, my dear lovable students. Sir, my question is, out of this 100 lakhs, how much should be debt? How much should be equity? How much should be preference? How much should be retained earnings? This decision is called as capital structure decision. This I will decide based upon the tool called as EBIT EPS analysis. Are you really with me? So, first of all, I have to take capital budgeting decision. Capital budgeting decision means if I am having money, I will purchase plant and machinery. Correct, sir? There I will take replacement decision. There I will take modernization decision. There I will take expansion decision. There I will take diversification decision. These are the major capital budgeting decision we will take. In order to take a dash budgeting decision, capital budgeting decision, we have to raise the fund. Are you already with me? There are various sources are there for raising the fund. Either you can raise the fund internally, that means through internal fund, or you can raise the fund through debt, or you can raise the fund through external equity. Are you already with me? Internal fund are called as reserves and surplus. Correct? Debt means debt. That means debentures. Yes, sir. And external equity means you are raising equity shareholders, sir, or preference shareholders. This is what need to raise the fund. So, I am going to do a capital budgeting decision. In order to take a capital budgeting decision, I have to raise the fund, right, sir? These are the various sources of fund. Then only I can take a capital structure decision. Sir, if there is no project, I don't want fund at all. Are you really with me? It is like business, how it will work like, okay, I am having 100 crores in my hand. I have to do something. Let me do this business. No, the business work covered. First of all, there should be a good project. If there is good project, in order to do that project, I need fund. என் கையில சும்மா கொஞ்சம் காசு இருக்கு அதுக்காக நான் என்ன ஒன்று பண்றேன் கிடையாது businessங்கிறது. Are you really with me? So the business should start with the capital budgeting decisions. That's what they are saying. Sir, through capital budgeting decision means a replacement decision or modernization decision or expansion decision or diversification decision. So I have to take one of these decision. For example, sir, I am ANM classes. I have to put another branch. That means I am going for expansion decision. All right, sir. Sir, now I'm doing only CA. I'm going to start ACCA. It's diversification. Are you really with me? Or I am going to increase modernize the classrooms. That is called as modernization. Or I am going to replace the existing camera with the new camera. That is called as replacement decision. To do any of this, I need what? Fund. I have to raise the fund. There are various options available to me as an owner. Either I can raise the fund through internally, or I can borrow the money, or I can go for equity. These are the main three options available with me. Are you all really with me? Sir, if out of these three options, how much should be the internal fund? How much should be the debt? How much should be the external equity? That percentage, that mix is called as capital structure decision. Capital? Okay, right. That means, sir, existing what structure? Capital structure. Then I will check that am I, sir, existing company or a new company? If I am an existing company, what is the existing capital structure? Currently, how much equity I am having? Currently, how much debt I am having? Currently, how much internal funds are available? Right, sir? And the payout policy, this is called as dividend decision. Are you all really with me? Yes, sir. Payout policy, because if I am having 100% payout policy, there is no internal fund at all, because there will be zero retained earnings, right? That means to do the project, I won't have the dash at all, internal funds at all. So my payout policy is also one of the factor which will determine the what structure decision? Capital structure decision. All right, sir. So what is my existing capital structure will decide, and my payout policy will decide. Based on that, I will make desired debt equity mix. Desired debt equity mix. Sir, when I make the desired debt equity mix, I have to see how much, what will be the effect on the return, and what will be the effect on the risk, and what will be the effect of what of capital? Cost of capital. Because of injecting more equity into the what structure? Capital structure. If KO increases or KO decreases or KO remaining constant, anything happen, my dear lovable students, sir, it will affect my value of firm. It will affect my. So I should take a decision where after I taking that optimum capital structure decision, my KO should be minimum. My KO should be, if the KO reduces, value of the firm increases. If KO reduces, so my dear lovable students, all these decisions I am going to take. So in my capital structure, how much should be the percentage of debt? How much should be the percentage of equity? How much should be the percentage of reserves and surplus? This is called as what structure decision. Fine. We are going to take the capital structure decisions that we will be making using a tool called as EBIT EPS analysis. What analysis? Before we talk about EBIT EPS analysis, First, we will be talking about capital structure theories. Capital, as I already introduced, that if two firms are alike in all aspects, except capital structure, will the value of the firm change or not is the question. Right, sir? The following approaches explain the relationship between what of capital, cost of capital, and what structure and the value of the firm. That comparison, that study is called as capital structure theories. That means what will happen to my KO, sir, if the capital structure changes. Now you should have the understanding that what is capital structure. That is the mix, the percentage of debt and equity in my capital structure is called as capital structure, and the VF, what of the firm. There are two theories are there, sir. Theory of relevance and theory of irrelevance. Tell me, theory of relevance and theory of relevance is saying that if two firms are alike in all aspects except capital structure, yes, the value of the firm will change. That is called as net income approach. What approach? And traditional approach. And what approach? No, sir. If two firms are alike in all aspects except what structure? Capital structure. How the value of the firm will change? That is called as theory of irrelevance, sir. Net operating income approach and Modigliani and Miller approach. Modigliani and. So set your mind. There are two theories are there. Theory of relevance, theory of. What is the argument of theory of relevance that you understand? If two firms are alike in all aspects except capital structure, yes, the value of the firm change. First of all, you should understand the basis of the argument, because one of the firms are only having equity. Other firm is having equity and debt. That means KD and KE is there. KD is the cheaper source of finance, whereas KE is a costlier source of finance. Correct? So if any company injecting debt into the what structure? Capital structure. Since KD is a what source of finance? Cheaper source of finance. Surely KO reduces. If KO reduces, value of the firm increases. This is what NI approach. What approach? Sir, according to this approach means what approach? NI approach. Capital structure decision is relevant to the what of the firm. So what NI approach is saying that if two firms are alike in all aspects except what structure? If one firm is a all equity firm and other firm is a levered firm, other firm is a, that means in the capital structure of the levered firm, what and what is there? Debt and equity there. This represent, the debt represent the KD and the equity represent the KE. This will be their KO. Are you all really with me? Whereas for all equity firm, in their capital structure, only who will be there? Equity will be there. So KE will be equal to, ennappa comfortable appa. That means, my dear lovable students, we know that KE will be cheaper source of finance and KE will be costlier source of finance and KD will be cheaper source of finance. So since the first guy is having only equity in their what structure? Capital structure, automatically their KE will be higher, automatically their KO will be higher. Comfortable. Whereas the second person, since we are going to take the WACC, that is weighted average cost of capital. Hello, sir. Since inside their capital structure, what and what is there? Debt and equity is there. In that, debt is a cheaper source of finance. Because of that, KD pulls down KO. KD pulls down KO. Because of KD pulls down KO, once the KO reduces, value of the firm increases. Value of the firm. So that's what they are saying, sir. According to this approach means NI approach. Capital structure decision is relevant to the what of the firm, value of the firm. An increase in financial leverage. Financial leverage in the sense means use of debt in the capital structure. That is called as financial leverage. If you are using debt in the what structure? Capital structure, you will say that such a situation is called as financial leverage. What leverage? Will lead to decline in the weighted average cost of capital. Yes, if I inject debt into the capital structure, sir, I am injecting KD into the capital structure, right? If the proportion of the debt increases, proportion of the cheaper source of finance increases. Understanding? If proportion of the cheaper source of finance increases, it pulls down the KO. If KO reduces, value of the firm increases. If KO reduces, that means while the value of the firm as well as market price of the ordinary share will increase. So what NI approach is saying that let the two company be there. Adha namakula sanda. Let the two company be there. Sir, this A Limited is doing only business of cloth, and even B Limited is also only doing business of what? Cloth. And 50 lakhs is the capital employed, and 50 lakhs is the what employed? Capital employed. Are you really with me? Assume the beta of this business is also 1.5 and beta of that business is also 1.5, right, sir? And EBIT generated by both the business are 40 lakhs and sir, EBIT generated by both the business are 12 lakhs and 12 lakhs. Let it be same. Still, value of the firm will change. What is the basis of such a statement by NI approach? Because NI is saying that what is the nature of A Limited? You are saying that it is a all equity company. It is a, if it is a what equity company? All equity company, its KO is equal to KE. Am I right? Yes, sir. KE does not have any tax benefit. Am I right? Yes, sir. It is the costlier source of finance. Are you really with me? The expectation of the equity shareholders will always be higher than KD. Correct? So automatically their KO will be higher. Their KO will be. But NI is asking a logical question that what is the nature of this firm? This firm is a levered firm. Levered firm means in their capital structure, who is there? Debt is there. That means KD is there and KE is there. Right, sir? KD is a what source of finance? Cheaper source of finance. So if you inject debt into the what structure? Capital structure, my dear lovable students, automatically KO reduces. So KO reduces, value of the firm increases. Value of the firm, this is what the theory of the NI. Conversely, a decrease in the leverage. Decrease in the leverage means if you are reducing the component of debt in the what structure? Capital structure will cause an increase in the overall cost of capital and consequence decline in the value as well as market price of the equity share. So what this approach is saying that if you are injecting more and more and more debt into the capital structure, sir, automatically the proportion of the debt in the capital structure increases, then it is a cheaper source of finance. Because of that, KO reduces and its value of the firm increases. Are you really with me? So the value of the firm on the basis of net income approach can be ascertained as follows. Sir, value of a firm is equal to value of equity plus market value of debt. So market value of equity plus market value of the debt. So according to the what approach? NI approach. They are saying that, sir, market value of the firm is equal to market value of equity and market value of debt. Market value of equity and market value of debt. Why are they saying, sir? Sir, if it is NI approach, if it is what approach, man? This is the basic understanding of the NI approach, my dear lovable students. Sir, always this capital structure is a comparison of the cost of capital. Correct? Sir, KE and KD are there. KE and? Sir, this KE will always constant. KE will always, and KD will always constant. KD will, that means if you inject more and more and more debt into the what structure also? Capital structure also, KD will be constant. KD will be, and KE will be constant. KE will be. Sir, since both are constant, look at here, man. This is the cost of capital percentage. And this is the leverage. Leverage means percentage of debt. Leverage means what? Percentage of debt. Sir, if there is no debt, you are saying that zero debt you are having. Then KE is equal to KO. It will be a dash equity firm, all equity firm. Are you really with me? But if you are introducing debt up to this, man, if you are introducing up to this level, have you introduced debt? Yes, sir. Then KD will not change. KD will be what? Constant. And KE will be what? Constant. Because of both the people constant, my dear lovable students, KO reduces. KO, look at the KO. This is what KO. Sir, this was the KO earlier. Because if there is no what at all, debt at all, KE is equal to KO. So this line represent earlier what? KO. KE is equal to KO, correct? But I inject this much debt into the what structure? Now the capital structure comprises of KD and what? KE. In that, KD is a dash source of finance, cheaper source of finance. Since it is a cheaper source of finance, it pulls down KO, which is nothing but KE. Are you all really with me? That's why the KO starts falling. Look at here. The KO starts falling. Now I again injected what into the capital structure? Debt into the capital structure. Then again KO starts falling. Are you all really with me? When I inject more and more and more debt into the what structure? Capital structure. Sir, my KO will start falling. If my KO reduces, my value of the firm increases. Are you all really with me? How to deal this, sir, in the examination? Sir, this is a 5-step approach. This is a 5-step approach. This is a... So, if question is coming from NI approach, deal it with 5-step approach. Always try to calculate EBIT and interest. Always try to calculate EBIT and interest. EBIT means earnings before interest and tax. Right, sir? And interest means whatever interest applicable to the firm. Then calculate the market value of equity. Market value of equity. And calculate the market value of debt. Market value of... If you calculate market value of equity, and if you calculate market value of debt, and if you add value of equity plus value of debt, you will get the total value of the firm. You will get the total value of the firm. This line only they are saying that, sir, value of the firm is equal to market value of equity plus market value of debt. Comfortable? Market value of equity plus market value of... Yes, sir. Why, sir? Under NI approach, I am calculating market value of equity and market value of... Because equity means KE and debt means KD. Correct? As per NI approach, both KE and KD are constant. So, constant means it will not change. So, I am finding out the item which will not change. Then I can find out the item which will change. That is KO. KO will change. Are you really with me? But this is a logic way. As per NI approach, my dear lovable students, market value of the firm is equal to market value of equity plus market value of debt. Market value of... Sir, once I find out the fixed item, I can find out the variable item. Are you really with me? The variable item is the overall cost of capital. That is what? KO. KO is the overall cost of capital. Is it fixed or constant? Is it, sir, constant or variable? Variable. It should be variable. Then only the NI approach will be theory of relevance. Because in order to be theory of relevance, the value of the firm should change. In order to value of the firm should change, my dear lovable students, KO should change. Are you really with me? So, EBIT divided by value of the firm. Tell me, EBIT divided by... So, my dear lovable students, if it is NI approach, what NI? Sir, net income approach is saying that these are our basic assumption. You will be having KD in your what structure? Capital structure. You will be having KE in your... Sir, the combination of these two is only what? KO. This will be treated as constant. This will be treated as constant. And this will be treated as variable. Are you really with me? Now, sir, what is the value of the firm? Value of the... Sir, value of the firm as per NI approach is saying that value of the firm is nothing but value of equity plus value of the debt. Are you really with me? Now, everyone is asking a doubt that what is value of equity? Value of equity is nothing, sir. Value of equity is equal to NIT, EBIT, minus interest. EBIT, because if a company earns EBIT, they have to pay interest to the debt holders. Are you really with me? Sir, balance only will be available to the equity shareholders. Are you really with me? That is the return the equity shareholders will be getting. Sir, divided by KE. Divided by... Just let me ask you a question. You are an equity shareholder in a company and in that company debt is there. Is company liable to pay interest? Yes, sir. Sir, the entire EBIT can be consumed by the equity shareholders. Or EBIT minus interest can be consumed. EBIT minus interest can be consumed. Are you really with me? Since the equity shareholders will get only EBIT minus interest, that is called as earnings available to equity shareholders. Earnings available to the equity shareholders. You tell me, man, once you become an equity shareholder, will you get earnings available to the equity shareholder for 1 year or 10 year or infinite years? Infinite years. That means the cash flow is a perpetual cash flow. Cash flow is a, sir, if cash flow is a perpetual cash flow, then value of an asset today is called as the value of equity. Are you all really with me? Is equal to cash flow divided by R. What is cash flow? EBIT minus interest. What is R? KE is the R. That is the rate. Are you all really with me? Sir, now you are the owner of the what also? Debt also of the company. Are you all really with me? That means, will you get EBIT, EBIT minus interest, or Veru interest? Veru interest. That means if you are debt holder, sir, you can enjoy only interest. Are you all really with me? This will be the future cash flow. Are you all really with me? Since this is a what cash flow? Future cash flow. The expected return will be KD. Expected return will be. That means, my dear lovable students, sir, value of equity plus value of debt is equal to value of firm. So I can say that value of firm is equal to value of equity plus value of debt. Value of equity is equal to, if you are equity shareholder, can you enjoy EBIT? EBIT minus interest. So EBIT minus interest, correct? Divided by NI. KE, are you all really with me? Plus the value of the debt means I can enjoy what? Interest divided by KD. Let me ask you a question. If you are holding 100% of the debt and 100% of the equity in a company, will you enjoy interest? EBIT minus interest? I will enjoy EBIT. Are you really with me? That means if I am 100% shareholder and 100% debt holder, I will be enjoying EBIT. Yes, sir. That means minus interest and plus interest, not mathematically, logically I am cancelling. Are you really with me? That means if I am holding 100% of the company, I can enjoy what IT? EBIT. Now I am the equity shareholder. I am the debt holder. That means KE plus KD is equal to KO. That's why the value of the firm is equal to, sir, EBIT divided by value of the firm will give you the KO. Are you really with me? That's the derivation of the formula they are saying. Simply they are saying that, sir, value of the firm is equal to EBIT divided by KO. But as per what approach? NI approach, I have to calculate the KO. KO is equal to EBIT divided by value of the firm. EBIT divided by, in other words, KO means cost of, overall cost of the capital. This can be written as return on investment. Return on investment is equal to return divided by investment. Am I right? Sir, what is a return? EBIT is a return. Are you all really with me? In order to enjoy EBIT, whether you have to invest value of equity, value of debt, value of firm. That's why value of the firm. So KO is equal to EBIT divided by value of the firm. Comfortable? That's it with regard to the first theory called as NI approach. NI is saying that try to inject more and more and more debt into the, if you are injecting more and more and more debt into the capital structure, because of the presence of the cheaper source of finance, that is KD, KD pulls down KO. Once a KO reduces, value of the firm increases. It's a 5-step approach, my dear lovable students. Step number 1, find out EBIT and interest. Step number 2, find out the market value of the equity. Aduk munnadi, sir, you have to EBIT minus interest you are supposed to do, right? EBIT minus interest. Sir, first you have to calculate EBIT and interest. Then market value of the equity. Market value of the debt. Then you will get the market value of the firm. Are you all really with me? Now you are having EBIT in your hand. You are having market value of firm in your hand. The expected rate is called as KO. Comfortable? I'm coming to the next one, sir. Next theory I'm going to explain called as net operating income approach. What approach? Sir, what NI said that, this is how you have to understand. NI, net income approach, said that 3 characters will be there. Are you all really with me? One is called as KE, other is called as KD, and other is called as what? According to NI approach, if you are having 10% debt or 90% debt, whatever may be the proportion of debt in the what structure, capital structure, your KE will be constant. Am I right? Sir, if you are having 0 debt or you borrow 100% debt, still the KD will be what? Constant. Sir, because of these two people, constant, sir, because of injecting cheaper source of finance into the what structure? Capital structure, automatically KO reduces. Right, sir? Now, NOI approach is having a criticism over the NI. NOI is asking that if you inject more and more debt into the capital structure, how the fear of the equity shareholders will be one and the same. Because earlier, if this is the capital structure, for example, 10 crore is the capital structure, you can have various options. Option number one, this is debt and this is equity and this is total. Always the total will be how much crore? 10 crore. You can have zero debt and you can have 10 crore as equity. Am I right? My dear lovable students, in option number 2, you can have 1 crore as debt and 9 crore as equity. You can have option number 3, you can have 2 crore as debt and 8 crore as equity. Total comes to 10 crore. Able to appreciate. In option number 4, you can have 3 crore and 7 crore and the total will be 10 crore. What NOI is asking that if you are asking me to inject more and more debt into the what structure? Capital structure, your analysis is correct. You are saying that KD will be constant. Are you all really with me? But NOI is asking a basic critical doubt to the NI that how KE will be constant, man. Because if you inject more and more debt into the what structure? Capital structure, automatically the bayam of the equity shareholders increases. So your basic assumption of KE constant is useless. Are you really with me? It is unacceptable. I can't accept that at any point of time. Because this is the KO, my dear lovable students. Sir, KO. Sir, this is KO. If you inject debt into the what structure? Capital structure. KD pulls down KO. KD pulls down KO. But sir, automatically the fear of the equity shareholders increases. They pulls up the KO and KO remain constant. And KO remain. If KO remain constant, value of the firm will not change. Value of the firm. Appa what NOI is saying that, Tambi, we are having 3 sources of items. Number 1, KD and KE and KO. I am saying that KD will be constant. I am saying that KD will be constant. Are you all really with me? And number 2, sir, KE will be not constant, will be variable. And KO will be constant. KO will be, sir, how the NOI will work na? This is the KO. This is the, when you inject debt into the what structure? Capital structure. KD is the cheaper source of finance. Because of that, KD pulls down KO. Now KO reduces, value of the firm increases. Idoda NI mudiju poichu. But NOI is saying that, illappa, if you inject debt into the capital structure, the bayam of the equity shareholders increases and KE increases and it pulls up KO and KO remain constant. That means KO will not change. If KO will not change, KO does not change, my dear lovable students, my value of the firm will not change. That's why NOI approach is a theory of irrelevance. Is a theory of, come on man, any change in the leverage will not lead to any change in the total value of the firm. NOI is asking that if first guy is doing serupu business and second guy is doing tuni business, then they can have different value of the firm. Are you all really with me? If both the people are doing same business with the same capital employed, with the same return, with the same risk, how the value of the firm will change? Simply because of the reason that one is a all equity company, other is a debt and equity company. Question arises. And the market price of the share and the overall cost of capital is independent of the degree of leverage. Whether you are injecting 10% debt into the capital structure or 20% debt into the capital structure or 30% debt into the capital structure does not matter at all. Whether you are having debt, not having debt, because of that, the value of the firm will not change. This is the ideology of the NOI approach. Are you really with me? As a result, the division between the debt and equity is what? Irrelevant for me. For the net operating income approach, as per this approach, increase in the use of debt, which is apparently cheaper, He is also accepting that KD is cheaper. There is no doubt about it. Is exactly offset. Is what? Exactly offset by an increase in the KE. That's what he is simply saying. Loose open dance. I don't relate with me. Yes, sir. This is what? What O? KO. Sir, when you inject debt into the capital structure, KD pulls down KO. Yes, and KE pulls up KO. KO remain unchanged. This happens because equity investors seek higher compensation as they are opposed to greater risk due to existence of fixed return securities in the what structure. If you inject more debt into the capital structure, automatically the risk of the equity shareholders increases. Risk of the, because the fixed interest bearing securities or the fixed amount increases. Are you all really with me? Then automatically, my dear lovable students, what will happen? You know, the expectation of the equity shareholders increases. When the expectation of the equity shareholders increases, KE increases. Are you all really with me? When KE increases, it pulls up KO and the KO remain constant. Actually, this is what the position of the KO. It goes down. Are you all really with me? Because of KD, and it comes up because of KE. And now KO is constant. Comfortable? What NOI is saying that as per my approach, whose approach? NOI approach. KD will be constant. KD will be. And KO will be constant. KO will be. And you have to calculate the KE. KE will be variable. KE will be. Now NOI is an ulta. NOI is an ulta of the NI approach. He said that step number 1, first calculate the EBIT and interest. First calculate the EBIT and for every company you have to see how much is the EBIT and how much is the interest. Hello sir. And according to the NOI, will the KO changes? Will not changes. Will not changes. If KO does not change, value of the firm changes, will not changes. So calculate the value of the firm. Calculate the, that should be the step number 2. Sir, should not be like market value of equity plus market value of debt. Anyway, the what of the firm will not change. Value of the firm will not change. So first to find out the value of the firm. Inside this value of the firm, 2 people are there. One is value of debt and value of equity. Is KD constant or variable? Constant. That means anyway value of the debt will not change. Right, sir? From the value of the firm, reduce the what of the debt? Value of the debt. Then automatically value of the firm minus value of the debt, you will get the value of equity. Value of, yes, my dear lovable students, can you find out EBIT minus interest in step number 1? Yes, sir. This is the earnings available to the equity shareholders. Sir, can you get the value of the equity? Yes, sir. So automatically their expectation will be KE. So step number 5, KE is equal to EBIT minus interest divided by value of the equity. Comfortable? So think like this. NI is saying that KD is constant, KE is constant, KO is variable. So first to find out EBIT and interest. Comfortable? Then find out market value of the equity. Then find out market value of the debt. You add market value of equity plus market value of debt. You will get the market value of the firm. You are having EBIT in your hand. You are having market value of firm in your hand. Find out the KO. Are you really with me? Because, sir, NI approach is a theory of relevance. So, there, in order to be theory of relevance, we have to calculate the KO. Comfortable? Whereas NOI approach is a theory of irrelevance. Their KO should not be the balancing figure. Either KD or KE should be the balancing figure. Comfortable? What is saying that KD is constant and KO as mandatorily to be constant. Are you really with me? Then the only balancing figure is what? KE. So, under NOI approach, we have to calculate the KE. Comfortable? So, how he is designing the problem? First, calculate the EBIT and interest. Then, straight away calculate the known figures such as market value of the firm. Inside the market value of the firm, market value of debt is there. Market value of equity is there. Are you really with me? My dear lovable students, remove the market value of the debt. You will get the market value of equity. You are having EBIT minus interest. You will be getting earnings available to the equity shareholders. Divided by market value of the equity, you will get the, that means NOI is saying that is a how many step approach? 5-step approach. Are you really with me? So the value of the firm is equal to EBIT divided by KO. EBIT divided by KO. Sir, V means what of the firm? Value of the firm. Sir, NOI means net operating income. KO means what of capital? Cost of capital. As per NOI, I am not liable to calculate the KO or value of the firm. I have to calculate the KE. KE is equal to EBIT minus interest divided by value of the equity. Value of the, that means as per NI approach, I have to calculate the KO. Correct? KO is equal to EBIT divided by value of the firm. EBIT will be given in the value of the firm will be value of equity plus value of debt. Comfortable? Whereas here KE is equal to EBIT minus interest divided by value of EBIT, and interest will be given in the question. Value of equity means value of the firm minus value of the debt. Can I proceed? Now I'm moving or entering into the next theory called as traditional approach. What approach? Traditional approach is asking one basic question with the same example. Look at here, man. ANI, you said that KD will be constant, KE will be constant, right? But NOI said that KE will not be constant, KE will be variable. KE will be variable. Am I right? NOI said that KD will be constant. Are you really with me? And here he said that KO will be constant. I am writing as per what approach? NOI approach. Right? Traditional approach is asking a basic question or doubt to both NI and NOI, saying that Ennappa ni solra, because you are asking me to inject more and more and more debt into the person who are giving debt to you. Sir, they won't have any risk. They won't have any risk. Even the KD should also increase. Sir, if you inject more and more and more debt into the what structure? Capital structure, the expectation, the risk of the debt holders will also increases. Then automatically KD increases and KE will also increases. My dear lovable students, if KE also increases, KD also increases, automatically KO increases. If the KO changes, not increases, KO, if the KO changes, then automatically value of the firm will change. Automatically. That's why, sir, traditional approach is called as theory of relevance. Because in order to be theory of relevance, my dear lovable students, who should change? KO should change. If KO changes, value of the firm changes. If value of the firm changes, it will be theory of relevance. Are you really with me? So what traditional approach is saying? That this approach favors that as a result of what leverage? Up to some point, cost of capital comes down. That means initially this traditional approach is supporting NI approach. Initially, traditional approach is saying that if you are injecting 10% debt into the what structure, what NOI said that KD pulls down KO and KE pulls up and KO remain constant. Traditional approach is saying that it is not like that. Once you inject 5 or 10% debt into the what structure, actually equity shareholders will enjoy that position. Are you really with me? Because financial leverage will work favorably. Are you really with me? Actually, trading on equity will happen. Actually, the equity shareholders will be having more EPS if you are having minimum debt. So, initially, what will work? NI approach will work. Initially, and value of the firm increases. But இதே ஒரு பழப்புன்னு சொல்லி beyond that point, reverse trend emerges. Beyond that point, reverse trend emerges means once you keep on injecting debt into the what structure? Capital structure, who will start react? Equity shareholders will start react. Once they start react, and who will also start react? KD will also start react. That means who will increase? KD increases and also KE also increases. But NOI, you said that it will be exactly offset. It will be, but the change will not be exactly offset. Sir, if KD increases by 5%, the KE will increase by 15%. It will be a steep increase. It will be a steep increase. That means KE will not be exactly offset, my dear lovable students. The principal implication of this approach is that cost of capital is dependent on the what structure. And there is an optimal what structure? Capital structure, which minimizes the cost of capital. This is the super point in the traditional approach, my dear lovable students. Sir, what NI is saying that KD is constant, KE is constant, and KO is variable. Correct, sir? Yes, sir. KO is variable. Whereas NOI is saying that KD constant, KO constant, and KE is variable. Able to appreciate? What traditional approach is saying that when you inject debt into the what structure? Capital structure, initially KO reduces. Initially. But if you inject more and more and more debt into the what structure? KD increases, even KE also increases. But the proportion of increase in KE will be much higher than that of KD. Are you really with me? Because of that, KO increases. Because of that, if KO increases, value of the firm decreases. Am I right? So up to a level, KE will not react. Up to a level, KE will not react. Up to a level, KD will not change. Are you really with me? ஒரு லெவல் தாண்டினதுக்கு அப்புறம் ரெண்டு பேர் என்ன ஆக ஆரம்பிப்பாங்க? இன்க்ரீஸ் ஆகும். அந்த இன்க்ரீஸ்ல யாரோட இன்க்ரீஸ் ரொம்ப அதிகமா இருக்கும்? கேயோட இன்க்ரீஸ். அப்ப அந்த இன்க்ரீஸ் ஆவர் அந்த பாயிண்ட் இருக்கு பாத்தியா? That is called as optimum capital structure. What capital structure? Under NI approach, you won't have optimum capital structure. Under NOI approach, you won't have optimum capital structure. Logic. Because, sir, when you inject more and more and more debt into the what structure? Capital structure, automatically KO reduces. 10% na I injected debt, then KO reduces by 10%. Correct? I inject more debt, 20%, then KO reduces by 20%. Are you understanding? If I inject 50% debt, then KO reduces by 50%. Are you all really with me? That means what is the optimum capital structure as per NI? There is no such concept. If possible, try to inject 100% debt. Practically, is it possible? No, sir. But NOI is saying that need debt inject pannamiru. Sir, KO is not going to change. If KO is not going to change, there is no question of optimum what structure at all. Capital structure at all. Are you able to appreciate? But traditional approach is saying that initially when you inject debt into the what structure? Capital structure, KO reduces. So when the KO reduces, value of the firm increases. Are you already with me? Are you able to appreciate? That means, my dear lovable students, after a particular point of time only, KO start increasing. Correct? So, in the point like KO rumba least arko, that point is the optimum what structure. Only under traditional approach, you will be having optimum capital structure. Under NI and under NOI, you won't have optimum capital structure. Can I proceed, sir? So what traditional approach is saying that KD will change, KE will change. If both the people changes, automatically KO will change. So KD will change. So according to this approach, KD will change, KE will change. Automatically KO will change. KO will also change. This is what the theory called as traditional approach. Are you really with me? So NI is a theory of relevance. NOI is a theory of irrelevance. And the traditional is a theory of relevance. Coming to the last one, the hero called as Modigliani-Miller approach. Modigliani, sir, the NOI approach, that is net operating income, is definitional or conceptual. It is correct only if you inject debt into the what structure? Capital structure. KO reduces because of KD. And KE pulls up KO. Are you all really with me? And it will exactly offset. This is what the theory of the NOI. But it lacks behavioral significance. எல்லாரும் கேக்குறாங்க, how it will exactly offset? Sir, NOI was speechless. He was not able to explain why it is exactly offset. So it does not provide operational justification. How it will operate, NOI was not able to say, for irrelevance of what structure? Capital structure. That's why who came as hero? Modigliani. However, Modigliani and Miller approach provides behavioral justification for constant overall cost of capital and therefore total value of the firm. Then, sir, there is a defect in the NOI approach, my dear lovable students. NOI approach said that, sir, net operating income, there is a defect. Conceptually, that is right. But operational justification, it failed. I will give you the operational justification. I will explain you how it will be exactly offset. That means Modigliani and Miller approach is an extension of the NOI approach. Are you really with me? Sir, this approach indicates that capital structure is irrelevant. If two firms are alike in all aspects except capital structure, sir, the value of the firm will not change because of the arbitrage process. Because of the, which will correct any imbalance. If there is any imbalance between the levered firm and the unlevered firm, then also it will correct, my dear lovable students. That expectation will change and at a stage will be reached where arbitrage is not possible. So there were defect with the NOI approach. Conceptually, NOI approach was correct. Whereas, sir, operational justification, it has failed. Who gave the operational justification? Modigliani and Miller approach. So Modigliani and Miller said that. Modigliani and Miller said that, sir, if two firms are alike in all aspects except capital structure, the value of the firm will not. He has explained one without tax and he has explained one with the tax. Sir, we are moving with this background. We are moving into the three questions what we are supposed to be solved. Sir, illustration number A, illustration number N and illustration number M. Shall we apply our discussion into the question, sir? This is a RTP May 2022 question. Following data relating to two companies belonging to the same risk class. Yes, when two companies are alike in all aspects except what structure? Capital structure. Will the value of the firm change or not is the question. Correct, sir? Sir, they are of same what class? Risk class. Same risk class. Hello, sir. Sir, when two firms are alike in what aspect only? All aspects only. I will do this chapter at all. Correct? Sir, this is B limited and this is C limited. B limited is having debt. That means B limited is a levered firm. Whereas C limited does not have debt. They are unlevered firm. What firm, man? Equity capitalization rate. My dear lovable students, 18% is the KE of the C limited. KE is equal to KO. Correct? And the expected net operating income, EBIT, is how much lakh? 9 lakh. Why both the company are having same EBIT? Because if two companies are alike in all aspects except will the value of the firm change or not is our discussion. Right, sir? You have to determine the total market value. Total market value means value of the and equity capitalization rate. Equity capitalization rate means and weighted average cost of capital. That means KO for each company. Sir, assuming no taxes as per MM approach. No taxes as per. Because there was defect in the NOI approach. That's why who came? MM approach came. Are you really with me? MM said that I will prove to you with the tax and without tax. And the second part of the question, determine the same total market value, determine the equity capitalization rate and weighted average cost of capital for each company assuming 40% tax as per the MM approach. Right, sir? So same question, the MM is going to prove that when two companies are alike in all aspects except capital structure, just because of the reason that one person are having debt and another person are having does not have debt, that because of that the value of the firm will not change. Are you really with me? If you critically analyze B limited and C limited, two company, my dear lovable students, inga paru, sir, this is with regard to company number 1 and this is with regard to company number 2. Right, sir? What is the EBIT of the first company? 9 lakhs. Okay. What is the EBIT of the second company? Same 9 lakhs because, sir, risk and return should be 1 and less what man interest. Sir, what is the interest paid by the first company? What is the interest paid by, which is 27 lakhs into 12 percentage. Am I right? 3 lakh 24,000. Yes, sir. So 3 lakh 24,000 is the amount of interest, right, sir? But the second company does not have what at all? Debt at all. Hence, there is no interest at all. Are you all really with me? Yes, sir. So, my dear lovable students, 9 lakh minus 3 lakh 24,000 comes to 5 lakh 76,000 is the profit before tax. Can I proceed? Whereas in the second company, 9 lakh rupees is a profit before tax. Why are you staring? Sir, there is no tax. Then why are you writing profit before tax? Sir? My dear lovable students, less tax, dash, dash. Okay, wow. So, my dear lovable students, what is a PAT? Profit after tax. The profit after tax in company number 1 is 5,76,000, right? And profit after tax of the second company is how much lakh? 9 lakh. Now, is asking a very logical question. If you are holding 100% of the company as a whole, will you enjoy interest EBIT minus interest EBIT? EBIT. That means if you are holding 100% of the company, you will get both interest and PAT. Am I right? What is the interest you will get? 3,24,000. What is the PAT you will get? 5,76,000. So 3,24,000 plus 5,76,000 comes to. That means if you are holding 100% of the first company, you will get 9 lakh. Right, sir? But if you are holding 100% of the second company, you won't have interest. The interest will be 0, but you will be having PAT of 9 lakhs. So then also you will be having 9 lakhs. That means, my dear lovable students, if there is no tax, if there is, according to approach, according to what? If there is no tax, value of the levered firm is equal to value of the unlevered firm. Value of the levered firm is equal to value of the, this is what the logic. This is what the logic. Are you really with me? Value of the levered firm will be equal to value of the unlevered firm. So always is asking that whether you are having tax, not having tax, start your calculation with the unlevered firm. Start your calculation with the. So I'm going to calculate, man, assuming there is no tax as per what approach? So calculation of value of firms, that is B limited and C limited according to hypothesis. Hello, sir. So the market value of the C limited, who's the second company? C limited. What is their specialty? Unlevered firm. is asking that always first value the unlevered firm because they don't have debt in their what structure? Capital structure. For them, KE is equal to KO. So KE already given as 18%. That means KO of that company will be also 18%. So I am going to value the market value of the firm, unlevered firm. Right, sir? Sir, value of a unlevered firm is equal to EBIT divided by KE or KO, whatever it may be. Hello, sir. Is the EBIT given in the question? If you are 100% owner of that company, you can enjoy EBIT of 9 lakh and your expectation is how much percent? 18%. So 9 lakhs divided by 18% comes to 50 lakhs. Sir, tax there, tax not there. The proposition of the Modigliani and Miller is if there is no tax, value of the levered firm is equal to value of the. If value of the levered firm is equal to value of the unlevered firm, technically means KO of the unlevered firm is equal to KO of the levered firm. Comfortable? So value KE of an unlevered firm given is equal to KO of unlevered firm is equal to 18%. Are you all really with me? Now, sir, I have completed the value of the dash firm, unlevered firm. If there is no tax, value of the unlevered firm is equal to value of the. Now I am going to calculate the market value of the B limited. That is the first firm. That is what firm? Levered firm. Sir, actually, if there is tax, actually, There is tax. Sir, value of the what firm is equal to? Levered firm is equal to value of the unlevered firm plus DT plus what? DT plus what? Sir, what is the value of the unlevered firm? 50 lakhs. Just now we calculated. Are you really with me? Plus you are having debt, but you are does not have the T. T stands for what rate? Tax rate. Ennappa? That means 27 lakhs into 0. So 50 lakhs will be the what of the firm. That means, sir, what MM's hypothesis is saying that MM, Modigliani and Miller, can be classified into how many categories? 2 categories, without tax and with the tax. Are you all really with me? If it is without tax means value of the unlevered firm is equal to value of the levered firm. Because whatever income you are getting from the levered firm, the same income you will be getting from the unlevered firm. Enapa clarity? Are you all really with me? Whereas, my dear lovable students, if there is tax, the value of the levered firm is equal to value of the unlevered firm plus DT plus what? DT. D means debt. D means tax rate. Can I proceed, sir? So here debt is there, but tax is not there. Are you all really with me? That means 27 lakhs into 0 comes to 0. So 50 lakhs plus 0 comes to 50 lakhs will be the what of the firm. So are you all settled? The settled in the sense means if there is no tax, value of the levered firm is equal to value of the. Now I am calculating the equity rate. That is equity rate. Are you all really with me? And the back. You tell me what is the B limited? B. B means what firm? Levered firm. Sir, why are you not calculating for C limited? They are already given in the question, which is KE is equal to KO. Sir, whose KE is not given? B limited's KE is not given. Are you really with me? Yes, sir. So I have to calculate the KE of the whose limited? Levered firm. Can we calculate KE? What is the EBIT of the company? 9 lakh. On that, the first company is liable to pay interest of 3,24,000. Comfortable? From the 9 lakh, if you reduce 3,24,000, earnings available to the equity shareholders are 5,76,000. Comfortable? Yes, sir. As per NOI, first you have to calculate the value of the firm. Am I right? Sir, I already said that MM approach is an extension of NOI approach. NOI fails to give operational clarification. Correct? Now MM is coming and saying that I will explain to you how exactly it will offset. So even the MM is also traveling the same route of the NOI approach only. NOI 5-step. Calculate the EBIT and interest. Then you have to calculate the value of the firm. Sir, in order to calculate the value of the firm is equal to EBIT divided by KO. But the KO of the levered firm is not given in the. Immediately, MM is asking that there is tax, there is no tax. There is no tax. If there is no tax, value of the levered firm is equal to value of the. That means KO of a unlevered firm is equal to KO of a levered firm. Accepting. Are you all really with me? That means, my dear lovable students, I have to adopt the KE as the KO of a unlevered firm. I have to adopt the KO of a unlevered firm as the KO of the levered firm. Puruncha? That means, my dear lovable students, 18% is the KO of the levered firm or unlevered firm, because there is no tax. If there is no tax, my dear lovable students, value of the levered firm is equal to value of the. So calculator man, sir, 5,76,000 divided by 18% comes to, sorry, 5 lakh, 9 lakh, sorry, 9 lakhs divided by 18% comes to 50 lakhs is the value of the levered firm, which is equal to value of the unlevered firm. Why? Because there is no tax. If there is no tax, value of the levered firm is equal to value of the. KO of a unlevered firm is equal to KO of the. Sir, inside this how much lakh? 50 lakhs. For an unlevered firm, only equity will be there. Am I right? But for a levered firm, both debt and equity will be there. In that, KD will be constant as per NOI. The same assumption is there for Modigliani and Miller approach also. Are you all really with me? That means out of this 50 lakh, how much is the debt included? 27 lakhs. So 50 lakhs minus 27 lakhs comes to 23 lakhs will be the market value of the equity. Market value of, that means, my dear lovable students, sir, in the levered firm, is debt is there or debt is not there? Debt is there. If what is there, debt is there, then automatically the fear of equity shareholders increases. Then it will not be 18%, it will be more than 18%, correct? So I am going to calculate the KE. Sir, KE means expectation of the what shareholder? Equity shareholder, which is nothing but earnings available to the equity shareholders divided by value of equity. What is the earnings available? 5,76,000 divided by what is the value of equity? 23 lakhs. So calculator man, 5,76,000 divided by 23 lakhs into 100 comes to 25.04% is the KE. Let me ask you a question. What is the KE of an unlevered firm? 18%. What is the KO of an unlevered firm? 18%. Because there is no debt in the what structure? That means the equity shareholders of an unlevered firm does not have BIAM. But the equity shareholders of the levered firm are having BIAM. Since they are having BIAM, automatically the return expected by the equity shareholders will also be more. Will also be. That's why it is not 18%. That's why it is 25.04%. But my dear lovable students, the KO of both unlevered firm and KO of both levered firm will be one and the same. How to calculate the KO, my dear lovable students? You can calculate the KO by, sir, what by what? EBIT divided by value of the firm. What is EBIT? 9 lakhs. What is the value of the firm? 50 lakhs. So 9 lakhs divided by 50 lakhs into 100 comes to 18% is the KO. 18% is the, sir, the same KO we can find out by using WACC table. In the levered firm, equity and debt is there. What is the market value of equity? 23 lakhs. Just now you find out, right? What is the market value of debt? 27 lakhs. What is the total value of the firm? 50 lakhs. That means here I am not putting the book value weight. I am putting market value weight. Are you all really with me? I can calculate the WACC using book value weight and what is my weight? What is my weight? That is 23 lakhs divided by 50 lakhs into 100 comes to 46%. 27 lakhs divided by 50 lakhs into 100 comes to 54%. Can I calculate the individual cost of capital? This is KE and this is KD, correct? My dear lovable students, KD already given in the question as how much percent? 12%. You tell me KO, sir. KO of a levered firm will be equal to KO of an unlevered firm if there is no tax. Conceptual clear? So it should be how much percent? 18%. Calculator 12% into 54% comes to 6.48%. Am I right? So calculator man, 18% minus 6.48% comes to 11.52% is the weighted KE. Is the what KE? So this should be 46%. Am I right? So calculator 11.52 divided by 46% comes to 25.04% should be the full KE. Sir, here 25.04%. Are you able to appreciate? That means one line summary of the entire discussion is MM approach can be classified into two categories. Without taxes and with the taxes. Are you really with me? If it is without taxes, man, value of the unlevered firm is equal to value of the, hence KO of an unlevered firm will be equal to KO of the. Fine, fantastic to the core. I'm moving into the next one, man. Assuming 40% tax as per MM approach. Are you really with me? Can I proceed as per 40%? Sir, with the tax, without tax? With the tax. If there is tax, value of the levered firm will be equal to value of unlevered firm. Or value of the levered firm will be more than the value of unlevered firm. More than the value of unlevered firm. I will prove you, man. The same question I can prove you, man. There are two companies are there, right, sir? Company number 1 and company number 2. Please help me. What is the EBIT? 9 lakhs. What is the EBIT of the second company? 9 lakhs. Sir, is the first company liable to pay interest? Yes, sir. What is the interest? 3 lakh 24,000. Second company put a dash. So earnings before tax of the first company 5 lakh 20 5 lakh 76,000. Are you really with me? 5 lakh 76,000. And here it will be 9 lakh. Sir, less tax at the rate of 40%, which is given in the question. So calculator man, 5 lakh 76,000 into 40% comes to 2,30,400 is the tax to be paid by the levered firm. Are you all really with me? Whereas 9 lakhs into 40% comes to 3,60,000 is the tax to be paid by the unlevered firm. That means the PAT, profit after tax, 5,76,000 into 60% comes to 3,45,600 will be the PAT of the levered firm. Am I right with my calculation? 9 lakh into 60% comes to 5,40,000 will be the PAT for the what firm? Unlevered firm. Now Modigilani and Miller is asking a basic question. My dear lovable students, if you, sir, have tax, if you are holding 100% of the debt and equity, will you get interest from the first company? You would have got interest of 3,24,000, and from the second company you would have got 0. Am I right? Sir, equity, sir, you would have got 3,45,600, and here you would have got 5,40,000. So calculator man, sir, total return from the company 3,24,000 plus 3,45,600 comes to 6,69,600 from company number 1 and 5,40,000 rupees from company number 2. Am I right? That means if there is tax, automatically the return generated from a levered firm should be more than the return generated from a unlevered firm. Then if there are two cows, one cow is giving a milk worth rupees 6,69,600 and another cow worth rupees 5,40,000, will you buy both the cow at the same rate? That's why is saying that if there is tax, value of levered firm is equal to value of unlevered firm plus DT. Plus what? DT. Plus what? DT. Are you all really with me? That means nothing but, my dear lovable students, look at here, man. Value. So calculation of value of firms, that is B limited and C limited according to hypothesis. Market value of C limited always as per First value the dash firm, unlevered firm. First value the unlevered firm. So for unlevered firm, look at here, man. Simple, man. You have to be with me. Sir, in order to value the levered firm, first I have to value the unlevered firm. Correct? Sir, value of unlevered firm is equal to basically EBIT divided by KE. This was the earlier formula if there is no tax. Correct? But if there is tax, sir, the equity shareholders cannot enjoy what? EBIT. Equity shareholders can only enjoy PAT. Are you all really with me? That means the value of NF firm is equal to unlevered firm is equal to EBIT into 1 minus T. EBIT into 1 minus T divided by KE. Divided by what? Tell me, what is the EBIT of the second company? 9 lakhs. 9 lakhs is the EBIT into 1 minus T. What is tax rate? 40%. So into 0.14 divided by what is KE? 18%. So calculator, 9 lakh into, sir, 0.6 comes to 5,40,000 is what? Look at here. 5,40,000 is the PAT. Are you really with me? That's what I've reached. If there is no tax, value of unlevered firm is equal to EBIT divided by KE. But if there is tax, value of unlevered firm is equal to EBIT into 1 minus T divided by KE. Puri the difference. That means 5,40,000 divided by 80%. So 5,40,000 divided by 80% comes to 30 lakhs is the dash of the firm. Value of the firm. If there is tax. If there is, let me ask you a question, sir, to ensure that you are with me for the calculation. My dear lovable students, have you calculated value of the unlevered firm? Yes, sir. Without tax? Yes, sir. What was the value? 50 lakhs. How much lakh? 50 lakhs. What is the tax rate? 40%. That means from 100 rupees, 40 will go. Remaining 60 will be there. So 50 lakhs into 60% comes to that 30 lakh only you have achieved or arrived here. Are you all really with me? So without tax, if the value is 50 lakh, and if I am paying a tax rate of 40%, with the tax, the value of the firm will be 30 lakhs. Are you all really with me? Now I have completed the valuation of the unlevered firm. Now I am going to calculate the value of the levered firm is equal to value of the unlevered firm plus DT plus what? Tell me, my dear lovable students, value of unlevered firm, if there is tax, will be how much lakh? 30 lakhs. Is debt is there for levered firm? அதனால தான் அது levered firm கூப்பிடுறோம். கரெக்டா? What is the debt? 27 lakhs is the debt. 27 lakhs is the debt. What is the tax rate, my dear lovable student? 40%. That means how much lakhs plus 30 lakhs plus 27 lakhs into 40% comes to 10,80,000 will be the DT. Right, sir? Abdina 30 lakhs plus 10,80,000 comes to 40,80,000 will be the value of the levered firm if there is tax. If there is appreciating, that means, my dear lovable students, 40,80,000 is the value of the levered firm if there is tax. Correct? But value of the unlevered firm is equal to how much lakh? 30 lakhs. That means 10,80,000 is the difference between value of the what in what? Levered firm and the unlevered firm. Right, sir? If you see, sir, if there is tax, if you are holding 100% of the levered firm, you can have 6,69,600. But if you are holding 100% of the unlevered firm, you are having only 5,40,000. Upper 6,69,600 minus 5,40,000 comes to, you will be having 1,29,600 extra. If you are holding 100% of the what firm? Levered firm. Can I proceed? Yes, sir. 1,29,600. Sir, why I am having extra 1,29,600? Because the levered firm have paid a tax of 2,30,400. Can I proceed? But the unlevered firm had paid a tax of 3,60,000. Correct? So 2,30,400 minus 3,60,000 comes to 1,29,600. This 1,29,600 extra is available with the levered firm. Comfortable? Why, sir, this guy has paid less tax? Why, sir, this guy has paid more tax? Because of interest. Because interest is a tax deductible item. Interest is a tax deductible item. Are you really with me? If you see the interest, if you see the question, they are saying that, my dear lovable students, 12% is the KD. 12% is the, sir, the second company is having 1,29,600. Is this for 1 year? Lifelong. Every year, this 1,29,600 will come. Every year, 1,29,600 will come. Right? That means the cash flow is a perpetual cash flow. What cash flow? The value of an asset today is equal to cash flow divided by R. The R is how much percent? 12%. So 1,29,600 divided by how much percent? 12% comes to 10 lakh. That is the difference between the first company and the second company, 10,80,000. That's what we are finding out as DT. That is a logic of debt into tax rate. Are you all really with me? Are you all really with me? So 40,80,000 is the value of the firm. Can I continue with the second part of the answer? So you tell me, sir, total value of unlevered firm, how much lakh? 30 lakh. Because if there is tax, the value of the unlevered firm reduces. Correct? What was the value of the firm if there is no tax? 50 lakh. From that, they would have paid tax of 40%. So 50 lakhs and the 40 lakh, 40% pochina 30 lakhs. Abdi calculate panna koodadu. Are you really with me? You have to calculate as EBIT into N minus C, 1 minus T divided by KE. Can I proceed? Yes, sir. So KE of an unlevered firm is equal to KO of an unlevered firm is equal to how much percent? 18%. Are you settled? Now I am going to calculate the market value of the B limited. That is what firm? Levered firm. Ippa na yara value panna poren? Levered firm. If there is tax, value of levered firm will not be equal to the value of the unlevered firm. If there is tax, value of levered firm will be more than the value of the unlevered firm. Comfortable? Yes, sir. So value of levered firm is equal to value of the unlevered firm plus DT. Plus what? DT. What is the value of the unlevered firm? 30 lakhs. Plus what is the debt in the levered firm? 27 lakh. What is the tax rate? 40%. So 27 lakh into 40% comes to 10 lakh 80,000 plus how much lakh? 30 lakhs comes to 40 lakh 80,000 is the value of the levered firm if there is tax. Comfortable? Now, sir, the WACC, weighted average cost of capital of C Limited. Who C? Unlevered firm. For them, the WACC is how much percent? 18%. Because KE is equal to, now I am going to calculate the KE and I am going to calculate the KO. Are you all really with me? Yes, sir. What is the EBIT of the levered firm? 9 lakhs. Less interest. Is there any debt in the capital structure? Yes, sir. Debt value of 27 lakhs. And the 27 lakhs interest 12% comes to interest of 3,24,000. Are you able to appreciate, sir? From the EBIT 9 lakh, if you reduce 3,24,000, what is the earnings before tax? 5,76,000. Is the levered firm liable to pay more tax or less tax? Less tax because of charging interest. Am I right? So less tax at the rate of how much percent? So 5,76,000 into 40% comes to 2,30,400 is the tax. Comfortable? So you will be getting a PAT, profit after tax, of 5,76,000 minus 2,30,400 comes to 3,45,600. Right? Already we calculated the what value of the firm. Always MM is saying that take the total value of the firm. In case yaar irkangana, tax irkangana, value of the levered firm will be higher than the value of the unlevered firm. Purida? That means already we calculated 40,80,000, which is much more than 30 lakhs. 30 lakhs was the value of the unlevered firm. Plus DT will be therefore value of the levered firm. Sir, inside this 40,80,000, sir, debt value will be there and also equity value will be there. Can you reduce the market value of debt? Yes, sir. How much lakh? 27 lakh. That means, my dear lovable students, market value of equity will be 13,80,000. Can I proceed? That means, sir, to the equity shareholders, 3,45,600 is the earnings available to equity shareholders. In order to enjoy 3,45,600, they have to invest 13,80,000. So calculator man, 3,45,600 divided by 13,80,000 into 100 comes to 25.0% is the KE. Is the what? And can we calculate the KO, my dear lovable students? Yes, sir. What is the formula for KO? KO is equal to EBIT divided by value of the firm. What is EBIT? 9 lakhs. So 9 lakhs divided by what is the value of the firm? 40,80,000 into 100 comes to 22.05. Yeah, it's the KO. Sir, what is the EBIT? 9 lakhs divided by 40,80,000 into 100 comes to 22 point. But sir, is this, sir, weighted average N of capital, cost of capital, is this NI approach? No, this is Modiglian Miller. So KO is equal to, I have to use the WACC table, correct? Can we calculate the WACC table? Tax bottom. Yes, sir. Tax bottom. Tax bottom tally. Wait. Sir, can I use the WACC table? Yes, sir. Sir, we are having equity and what? Debt. What is the market value of equity? We just find out 13,80,000. What is the market value of debt? 27 lakh. So total value of the firm 40,80,000. Can I calculate the weight? Yes, sir. Can I calculate the, sir, K individual cost of capital? Already I find out KE as 25.04%. I will not take KD as 12% because tax is there. Correct? If tax is there, cost of capital should be after tax. Hello, sir. So 12 into 60 percentage comes to 7.2 percentage. Comfortable? If I calculate, I will get 13.23 percentage. If you want, by using formula method, don't take the KO as EBIT divided by value of the firm. This will work out only if there is no tax. Correct? If there is tax, EBIT will not be available to the what shareholder? To the all shareholders. Are you really with me? Actually, the KO means the total return. Correct? So don't use this formula, because this formula will be applicable only if there is no comfortable. Yes, sir. So the WACC will be 13.23 percentage. Sir, but the WACC of unlevered firm was how much percent? 18 percentage. Correct? But the WACC of, sir, levered firm is how much percent? 13.23 percentage. அப்ப ரெண்டு பேரோட WACC என்ன ஆவல? Match ஆவல. Match ஆவலனா WACC is changing. KO is changing. That means MM should be theory of relevance. MM cannot be theory of. That's why from there arbitrage process is starting. What MM is saying that if there is tax, surely initially value of the levered firm will be more than the value of the unlevered firm. And slowly people will start fry from the levered firm to the unlevered firm, called as primary arbitrage. Correct, sir? So we are having basically four theories are there. NI approach, NOI approach, traditional approach, and the Modigliani Miller approach. Right, sir? If you ask me to tabulate the five theories, my dear lovable students, sir, number one, NI, number two, NOI, number three, traditional, number four, MM without tax, and MM with tax. Are you really with me? What NI? Three characters are there: KD, KE, and KO. Are you really with me? What NI is saying that KD will be constant, KE will be constant, and KO will be variable. Hello, sir. What is the rule? What is the rule of NI? NI is saying that try to inject. Try to inject more, and more debt into the capital structure. Into the capital structure. Since KD is the cheaper source of finance, KD is the cheaper source of finance, KD pulls down KO. KD pulls down KO. When KO reduces, value of the firm increases. When KO reduces, value of the firm increases. Are you all really with me? Yes, sir. Now coming to NOI, man, KD is constant, KE is variable, and KO is constant. KO is constant. The rule of NOI approach is saying that, what the theorem or the rule is saying that, if you inject debt into the capital structure, since KD is cheaper source of finance, KD reduces KO. But this but is the theory, correct? But fear of equity shareholders increases, and automatically KE increases, and it exactly offset. Hence, KO remain unchanged. Right, sir? Hence, KO remain unchanged. Come on, man. Traditional approach. What tradition is saying that KD is variable, KE is variable, hence KO is variable. Everyone is variable. Traditional approach is saying that when you inject more debt, when you inject debt into the capital structure, when you inject, sir, debt into the capital structure, when you inject debt into the capital structure, initially equity shareholders enjoy financial leverage. Equity shareholders enjoy financial leverage, and equity shareholders enjoy financial leverage. Equity shareholders enjoy financial leverage, and initially KO reduces. Initially KO reduces. Such point is called as optimum capital structure. Optimal capital structure. Optimal capital structure. Optimal capital structure. Comfortable? With regard to MM, without tax, if there is no tax, value of unlevered firm is equal to value of the levered firm. Value of unlevered firm is equal to value of the levered firm. Value of unlevered firm is equal to value of levered firm. Comfortable? Hence, KO of unlevered firm is equal to KO of levered firm. Hence, KO of unlevered firm is equal to KO of unlevered firm. Here, KO is equal to EBIT divided by value of the firm. EBIT divided by value of the firm. EBIT divided by value of the firm. Here, if there is tax, value of unlevered firm will not be equal to value of the levered firm. Value of unlevered firm will not be equal to the value of the levered firm. Hence, value of levered firm is equal to value of unlevered firm plus DT. Value of levered firm is equal to value of unlevered firm plus DT. Value of unlevered firm plus DT. Okay, sir? Yes, sir. And if tax is there, value of the unlevered firm is equal to EBIT into 1 minus T divided by K. K or KO, whatever it may be. EBIT into 1 minus T divided by K. EBIT into 1 minus T divided by K. Comfortable? With this, my dear lovable students, the concept revision of the first chapter, that is capital structure theories, comes to an end. And we have done with question number 1, which is question number A. In the coming slot, we'll be solving again MM. You have to revise the theory, whatever we have done. The 2 questions we'll be solving, which we will be feeling it as very cakewalk to proceed, my dear lovable students. We will be, discussing a superb 2 question, past examination and RTP question. Have a full revision of theory, NI, NOI, traditional, MM without tax and MM with tax. Are you all clear?